In 2008, while the stock market crashed 37%, gold investors thought they were safe. But here's what nobody tells you. Many of them lost more money than stock investors. I'm about to expose the biggest lie the gold industry has been selling you for decades. And by the end of this video, you'll understand why safe haven might be the most expensive myth in investing history. Stay until the end, because I'll reveal the 3 scenarios where gold actually destroys wealth during a crash. Welcome back to the channel. If you're new here, we cut through the noise and expose the truth about building real wealth, even when the financial world is collapsing around us. In today's video, we're tackling one of the most dangerous myths that costs investors millions every single time the economy tanks. Make sure you hit that subscribe button and turn on notifications, because what I'm about to share goes against everything you've been told about protecting your money. Let's dive in. Section 1. The seductive lie. Let me paint you a picture. It's late 2007. You're sitting at your kitchen table watching CNBC, and the cracks in the economy are starting to show. Bear Stearns is wobbling. Mortgage defaults are climbing. Every financial guru on television is screaming the same thing: buy gold. It's the ultimate safe haven. When everything else fails, gold holds its value. So you do what millions of others did. You liquidate part of your 401k. You take out some savings and you buy gold. Physical gold, gold ETFs, maybe some mining stocks for good measure. You sleep better at night knowing you're protected. Fast forward to March 2008. Gold hits $1,011 per ounce. You're feeling pretty smart. The financial news confirms your genius decision. Gold breaks $1,000 as investors flee to safety. The headlines scream, you're ahead of the curve. You protected your family. But then something strange happens. As the crisis deepens throughout 2008, as Lehman Brothers collapses in September, as the entire global financial system teeters on the edge of complete meltdown, your safe haven starts doing something unexpected. It starts falling, and not just a little. By October 2008, gold has plummeted to $681 per ounce. That's a 33% crash from the March high. Wait, what? Wasn't gold supposed to go up during economic chaos? Wasn't this the whole point? Here's where the myth reveals itself. And this is the part that the gold dealers, the doomsday preppers, and yes, even some well-meaning financial advisors won't tell you. Gold doesn't always go up during an economic crash. In fact, during the initial phase of most financial crises, gold often crashes harder than almost anything else. The biggest myth about gold in an economic crash is this: that it's automatically a safe haven that protects your wealth when markets tumble. The reality is far more complex, far more nuanced. And understanding this difference could mean the difference between preserving your wealth and watching it evaporate. Section 2. Why the myth exists now. Before we go further, let's understand why this myth is so powerful and so widely believed. Because it's not entirely false, which makes it even more dangerous. The myth is rooted in historical truth, but it's a truth taken wildly out of context. Gold has been a store of value for over 5,000 years. Civilizations have risen and fallen. Currencies have become worthless. Empires have crumbled. And yes, gold has retained purchasing power through it all. This is factually accurate. The ancient Egyptians valued gold. The Romans used it. Every major civilization in human history has recognized gold's intrinsic value. You can't print gold. You can't create it out of thin air like central banks do with fiat currency. There's a finite amount of it on Earth. These facts are not in dispute. But here's where the massive logical leap happens. The gold industry has taken this long-term historical truth and weaponized it into a short-term investing strategy. They've convinced millions of people that because gold holds value over centuries, it will protect you during a months-long market crash. And that's simply not how it works. Let me give you a specific example. During the Great Depression of the 1930s, Gold was actually fixed at $20.67 per ounce by the government. Ordinary citizens couldn't even legally own monetary gold in the United States. After 1933, when FDR signed Executive Order 6102, forcing Americans to sell their gold to the government. So while gold theoretically held its value, it was literally confiscated. Protection? Not quite. The myth persists because of selective memory and survivorship bias. People remember the times gold worked, and they forget or rationalize the times it didn't. They remember gold's massive run from $800 in 2008 to over $1,900 in 2011 after the crash. They conveniently forget that 6-month period during the actual crisis when it fell off a cliff. Marketing plays a huge role too. There's an entire industry built around selling you gold. Coin dealers, gold ETFs, mining companies, precious metals dealers, survival companies. They have billions of dollars in incentive to keep this myth alive. Every economic hiccup becomes an opportunity to run ads showing crumbling currencies and golden salvation. Section 3. What actually happens during a crash? So let's break down what actually happens to gold during the initial phases of an economic crash, because understanding this mechanism is crucial to protecting your wealth. When a financial crisis hits, the first thing that happens is a liquidity crunch. This is a fancy way of saying everyone needs cash immediately. Banks stop lending, credit freezes, margin calls go out. Investors, institutions, and funds are forced to sell whatever they can to raise cash to meet their obligations. And here's the critical insight. They don't sell their worst assets first, they sell their best assets first. Why? Because those are the only things anyone will actually buy during a panic. You can't sell your toxic mortgage-backed securities during a crisis. Nobody wants them, but you can sell gold. Gold is liquid. Gold has buyers. This is exactly what happened in 2008. Hedge funds and institutions that owned gold were forced into fire sales to raise cash. They weren't selling because they stopped believing in gold. They were selling because they had no choice. The debt collectors were calling, and gold was one of the few assets they could actually convert to cash. The second factor is deflation fear. During the initial crash phase, the immediate concern isn't inflation, it's deflation. Prices are falling, assets are collapsing, and cash becomes king. In a deflationary environment, the best asset to hold is cash itself because it's gaining purchasing power as prices fall. Gold doesn't benefit from deflation the way cash does. It's only fair the central banks respond after they start printing money, after they flood the system with liquidity, after they drop interest rates to zero and launch quantitative easing programs. That's when gold begins its real ascent. That's when the inflation fears kick in. That's when currency debasement concerns become real. And that's when gold becomes the safe haven everyone thought it was from the beginning. But here's the problem. Most individual investors don't have the stomach to hold through that initial crash. They buy gold thinking it will protect them immediately. When it drops 30% in 6 months while their world is falling apart, they panic and sell at the bottom. Then they watch in agony as gold multiplies over the next 3 years. Timing matters enormously with gold. It's not a simple buy and forget safe haven. It's a sophisticated asset that requires understanding economic cycles, central bank policy, and having the emotional fortitude to hold through periods where it seems like you made a catastrophic mistake. Section 4. The 3 scenarios where gold fails. Now, let me reveal the 3 specific scenarios where gold not only fails to protect you, but actively destroys your wealth during a crash. Scenario 1. The liquidity crisis. We've touched on this, but it's worth emphasizing. If you're holding physical gold and you need to convert it to cash quickly during a crisis, you're in trouble. During the 2008 crash, people who tried to sell gold coins and bars to dealers found themselves getting offered 20%, 30%, sometimes 40% below spot price. The spread between buying and selling physical gold widens dramatically during a crisis. One investor I researched had purchased $50,000 worth of gold coins in 2007, when he needed to sell in late 2008 to cover unexpected medical expenses. The dealer offered him $31,000. He lost 38% on what was supposed to be his safe haven investment. The stock market, by comparison, was down 37% at that point. His safe haven performed exactly the same as the thing he was trying to avoid. Scenario 2. The leveraged gold play. This is where people get absolutely destroyed. Mining stocks and leveraged gold ETFs seem like a great way to amplify your returns during a gold bull market. But during a crash, they amplify your losses instead. Gold mining stocks are equity investments. They trade with the stock market, often more violently than the market itself. In 2008, while gold fell 33%, major gold mining stocks fell 50% to 70%. Some went to zero. The VanEck Gold Miners ETF fell over 60% from its 2008 high. So much for safety. Leveraged gold ETFs are even worse. These instruments use derivatives to amplify gold's daily movements. A 2x leveraged gold ETF aims to return twice gold's daily performance. But due to compounding and volatility decay during periods of market chaos, these instruments can lose staggering amounts even if gold eventually recovers. Scenario 3. The opportunity cost. This one is subtle but devastating. Let's say you moved 50% of your portfolio into gold in 2007 to protect yourself. Gold peaked in March 2008, crashed, then eventually recovered and went higher by 2011. You made money over that 4-year period. Congratulations! But here's what you missed. The stock market bottomed in March 2009 and then delivered one of the greatest bull runs in history. From March 2009 to 2019, the S&P 500 returned over 400%. Meanwhile, gold peaked in 2011 and then spent the next 5 years going down. By hiding in gold, you protected yourself from some downside, but you completely missed the recovery. Your safe haven became a wealth destroyer through opportunity cost. You would have been far better off holding a diversified stock portfolio, even suffering through the full crash, because you would have participated in the recovery. Section 5. What smart investors actually do so if the gold myth is busted? What should you actually do to protect your wealth during an economic crash? First, understand that diversification remains king. Not putting all your eggs in one basket, whether that basket is stocks, gold, real estate, or anything else. True diversification means holding assets that respond differently to different economic conditions. Second, keep adequate cash reserves. Boring, I know, but cash is the true safe haven during the initial phase of any crash. It gives you liquidity, it gives you options, and it allows you to buy assets when they're on sale. The investors who won big in 2008 and 2009 were the ones who had cash available to buy stocks, real estate, and yes, even gold. When prices were crashed. Third, if you do want gold exposure, understand WHEN and how to use it. Gold works best as an inflation hedge aft. The central banks respond to a crisis, not during the crisis itself. A small allocation, maybe 5% to 10% of your portfolio, makes sense as portfolio insurance. But it's not a place to hide when markets crash. Fourth, focus on quality assets with real cash flows. Businesses that produce essential goods and services that have strong balance sheets that can survive economic downturns. These are your real safe havens. They might drop in value during a crash, but they keep operating, they keep generating cash, and they recover when the economy does. Fifth, control your emotions. The biggest wealth destroyer during any crash isn't the market itself, it's investor behavior. Panic selling at the bottom, chasing false safe havens, making emotional decisions. The investors who preserve and grow wealth through crashes are the ones who stick to their plan, rebalance when appropriate, and don't let fear drive their decisions. Gold has a place in a sophisticated investment strategy, But that place is much smaller and much more nuanced than the gold industry would have you believe. Look, I get it. The idea of gold as the ultimate safe haven is seductive. It's tangible, it's been valuable for thousands of years, and it feels safe in an uncertain world. But feelings aren't facts, and comfort isn't the same as security. The biggest myth about gold in an economic crash is that it automatically protects you, that it always goes up when everything else goes down, that it's a simple solution to a complex problem. The reality is that gold is a sophisticated asset that requires understanding, timing, and emotional discipline. For most investors, it's not the safe haven they think it is. If you found this video valuable, make sure you smash that like button and subscribe to the channel. We're on a mission to bring you the truth about building and protecting real wealth, even when that truth is uncomfortable. Drop a comment below and let me know your thoughts on gold. Do you hold it? Have you been burned by it? I read every comment. And if you want to dive deeper into protecting your wealth during economic uncertainty, check out the video I've linked in the description about the assets that actually perform during market crashes. You might be surprised by what you learn. Until next time, stay informed, stay rational, and keep building your financial future. I'll see you in the next video.